Hi, I'm Prashanth Ranganathan. I'm the founder and CEO of Finance, based out of India. And I'm really excited to be speaking to you all this morning.
एक मिनट रुक जाओ, रेडी होने दो। चलो ये कर लेते हैं। This could be a great intro.
There is a long history going all the way back to Mohandas Karamchand Gandhi of Indians who are settled abroad deciding to come back to India to solve Indian problems. But each such story follows a unique path. And in this episode, Akshay Dutt talks to Prashanth Ranganathan about building one of India's leading lending fintech startups. Prashanth is a Stanford-educated techie who spent time in the epicenter of the startup world with some of its most important companies and people. After a successful leadership journey at PayPal, he decided to build a fintech startup in India, which possibly became the most testing period of his life. But like all good tests, it taught him many lessons. Listen on to Prashanth's fascinating story of building PaySense, which is now PayU Credit.
Yeah, at Stanford, it's one of the first places I've ever been where if you graduated, you're a failure, right? The expectation of university is that you stop out or you drop out to start something before you graduate, right? That is the base expectation. It's probably the unwritten expectation, but that is the expectation. So I would see people constantly. I mean, this is the time where like you would see the Google guys, the Larrys and the Sergeys coming back. They were still coming back to graduate parties and stuff like that, and it was just cool. Like you would see Zuck come on campus and talk to us, but because at that time these guys were not that big. Like this was like 2004. It was still quite. I mean, yeah, Google was quite large, but still very early days compared to where they are today, right? So you can see, and that's when I also met Mark and Reese. And Mark was, of course, used to frequent campus, and through a friend, I met him, and he was like, "Hey, I'm doing like an apprenticeship program. Maybe you should consider it." And I looked at that program. I was like, "Oh, this is kind of cool." I spent time with Mark, work on some interesting stuff. And Mark very early on was like, "Hey, like you don't go from Stanford and then go back to your corporate job. Right? You don't go back and say, oh, I'm going to work on developer tools for Microsoft." He's like, enterprise is dead, work on consumer stuff, the web is it. And even back then he was like, the web will transform into portable, mobile applications. Look out for that. Right. So I actually went from graduating bioinformatics to becoming an apprentice for Mark. And for me, the conversation with my parents was really hard because I went from whatever, like making a few $100,000 at that time at Microsoft to making $3,000 as a stipend with Mark a month. So it was, and I had picked up a graduate degree along the way, right? So you think that every time you pick up a degree, you pick up like a little bit more on the comp front. I actually went like massively the other way. But from an experience standpoint, I always knew that this was not the be all end all. I wasn't going to be Mark's apprentice for 40 years, right? I just knew that this would be the place I would meet the people I wanted to meet, pick up technologies that I wanted to pick up, learn something that I wanted. And that's what happened. In 6 months, I met Nikhil Singhal, who was just consulting with them, helping Mark and the team. The company that I was a part of was called Ning, N-I-N-G. And and then I went off and started my first company with Nikhil.
So with Mark, you were like an investment analyst kind of thing, like.
No. So Mark and this lady, Gina Bianchini, had set up a social web app type of a company, right? They were saying Facebook is the owner of the graph, like the social graph. And there will be companies that will build social apps, right? And initially their thinking was we will build our own social network, like bring your own social network to this platform, right? Called Ning. Like I would say, hey, I want to build a social calendar, right? So today calendar is very personal, but I would build a social calendar where I would share my calendar with Akshay and my wife and 4 other people, and people would put stuff and play dates could be organized and whatnot, right? That was the concept. So I was embedded in that company to build. So they were building the core infrastructure and I was building the applications, the reference apps to showcase the power of the underlying platform, right? And that was fun because I'd never done anything in consumer. I'd never done anything with web programming. And so that was fun for me. And part of that was I also got to spend some time with Mark, and just to kind of dig into his own brain and see how he thought about things. And for me, it was radical, right? Like, it was very different than a very structured, linear way of thinking about things. He would always talk about stuff that's going to happen in 5 years or 10 years and how to prepare for that. And this is the whole like skate to where that you think the puck is going to be, not where it's at. And so that was constantly reinforced. That plus the fact that you don't graduate Stanford to go back to a corporate job, or you're already a failure because you graduated Stanford, and it compounded towards my first startup.
So what did you start with, Nikhil?
So Nikhil was a seasoned entrepreneur. He'd built a company called Casa and System Pass and sold it. And again, I'm going to share this part because I think it's important for people to understand. He was always very sure that he was going to start something. And it didn't matter to him what it was going to be, right? It was very vague. And they were like, hey, we're going to do something with like telephony, and it's going to be like a phone IVR based thing. The initial concept was that they would do like a podcast on the phone. And he was like, dude, you should come and be my product manager, like head of my product manager, be on the founding team, etc. And in the time that my H-1B got transferred from where I was onto this company, because they had to get capitalized, etc. But they'd raised money and they were further along, and what I thought I was going to get in terms of shares and what I got ultimately were quite different. But that's besides the point, because for me, what was great at like 26 or 27 at this time was the experience that I was going to have as like a head of product for a new nascent company that had no product market fit in an empty canvas to go and play out. He was very supportive. Of course, I made a lot of mistakes along the way, but I was razor focused on helping this company get product market fit. So the company ultimately pivoted from podcasts on the phone to a group voice messaging company. And I pushed it down that path. I said, hey, look, Twitter is not authentic. When you get a message on Twitter from the real Donald Trump or Akon or Rihanna, how do you know it's them typing versus it's one of their publicists typing, right? But voice is very real. Voice is very authentic. What if you could build a system where Chris Brown could record a message and hit broadcast, and it would go to like 1 million fans whose phones would like message or ring, and they would listen to it. They could respond. And when they responded, all that audio would go back and show up on his MySpace or wherever he wanted to put our widget. That's what that company became. It became like a social voice communication, group voice communication company. There was something similar in this part of the world called Bubbly. I don't know where it went. But ultimately, SayNow, the company that we had formed and built, got sold to Google. I didn't end up going to Google at that time. All of those years later again for the second time. But that's where the company ended up. For me, I think I was like, man, I saw the return on investment, right? Like, they had started this 3 months prior. Yeah, I was there every step of the way, all the way through. I drove the quote unquote initial product market fit and everything else. But the return for them was like much, much, much larger than what it was being. But for me, what it did is it set me on a certain path, right? So that I was not upset that there was tens of millions of dollars between us. For me, what it meant is now using that platform was time for me to go start again. So I actually then stepped out and I was doing some consulting, which then resulted in my second startup.
So you had enough cash from that exit to Google to like fund your next venture? Like, was it substantial enough? Like,
yes and no. So yes, there was enough, but I was just kind of picked up a consulting gig. I didn't want to kind of just take all my money and put it into something. I picked up a consulting gig because I wanted a rolling start. I wanted to work with a company, figure out the problems that they were facing, and kind of solve for them. My ambition wasn't that big at the time. I was like, okay, I could just build something for these guys and sell it back to them. Unfortunately, they didn't want to buy.
What was that gig like?
Yeah, so it was a company called Quova, and they were in the IP location space, like geo IP location space. So what I was noticing is that they were...
Quick question. Yeah. What is geo IP location? Like the geolocation, like what Uber uses, like.
Exactly. So every computer, every device has an IP address, right? Like it's a location. It's the endpoint, right? So what the technology we had built would help people say, given an IP address, they could say where it is, right? So if I took your IP address right now, I should be able to say, well, you're somewhere near Tokyo, Japan, right? Because that IP address, that block was assigned to a carrier in Japan, and they have sub blocks, and everyone has a certain structure, and that's how it got pinpoint. And basically, there's a lot of value in that, because if I'm Netflix, I can say, okay, this person's coming from Japan, apply Japan DRM, right? Like only allow him to see content that's licensed for Japan. Or if you're gambling, you don't want people from certain countries because they're not legally allowed to gamble, right? Or whatever. There could be various restrictions placed in terms of content, in terms of access. What I realized when I was working on like how to just enhance their algorithms, technologies to make it big better. Again, this comes back to my big data, bioinformatics past, because I had worked on a lot of these algorithms before, and I knew how to apply it for this problem. It's not biology, but it's very, very, very large amounts of data that I could crunch and process to do something, right? So that's where I started using it. And while I was doing it, I would go on these sales calls with the sales guy. I was just a consultant, and I would just go, and what I would hear is these companies were actually buying this raw, like database data from us. And then they were building all this logic on top of it to, detect where someone is coming from and apply all those rules. And so what I wanted to quickly build, and what I was talking to the CEO about is, hey, like, why don't I build an application with my own money, with my own time? I'll build an application which will allow the companies that you're selling to the ability to detect if someone is coming through a proxy, right? You're not spoofing your IP address, or let me build some technology that would like give you a strong device fingerprint. Or in the case of like mobile payments, maybe I can help you guys like build something that would like give you like a lot of security related signals, right? Like, so you can process mobile payments. Built all, and she was quite supportive, and I built all this. But just when I had built everything, right? It took me like 8 months or something to build all this, and I had hired a couple of consultants, spent a lot of my own time, built all this. Just when I was ready, they went through an acquisition, right? And so then my work became very second order business, right? So then here I was, I had spent all this money, spent all this time building all this stuff, and nothing was going to come off it. So I decided I'm just going to spin it into a company, right? So I was like, okay, well, I can license their data and I can take all my technology, I'll sell it, right? So that was actually the birth of the second company. I was like, okay, I'm going to do it on my own, because the person I built it for is in no position to buy it. And I was frankly going to sell it to them for, I think, like a couple of $100,000, if that. But what ended up happening is I ended up saying, okay, no, I'm going to build my own, and started looking to raise capital. As I was looking to raise capital, I ran into the guys at PayPal. They were like, hey, we don't like all the other stuff you did, but this mobile payment security stuff that you've built here is really interesting. Can you come back and tell us more? So I, over like a 3-day period, changed the entire pitch to make it only about mobile payment security, how this was the best way of detecting proxies, how this was the best way of device fingerprinting, how this was the best way of picking up mobile fraud. Built out an entire application suite on top of it, went back and pitched there. And I said, hey, I'm looking to raise a couple of $100,000. And they were like, this stuff is so cool and so important and so integral in what we do, is that we don't want to fund you and have you go sell it to 5 other people. We want to hold this for ourselves. And all of a sudden the table changed, right? And I was like, oh, well, I'm not really selling. The same stuff I was going to sell for $300,000 like a month ago, right? Suddenly I'm not going to sell. I intend to build it. And so then I'm like, well, if there's one buyer for this, let me go talk to Visa. Let me go talk to Google Pay. So I started those conversations. And again, the word went back to PayPal that, hey, this guy is looking to sell. And then they came back with an offer I just could not refuse. And it was not a $300,000 offer. It was a game changer. And all of a sudden,
like a complete buyout or like investment? Buyout.
They came back and said, hey, it's a complete buyout and you can build it here. And so then that's how I ended up at PayPal. It was complete buyout. It was my first full acquisition. I owned at that point 99.8% of the company. I had not really raised any money. But, as those conversations were dragging on, this is where I think my wife plays a big role. I got married and I'd already spent a lot of the SayNow money and whatnot. And so we were getting married. And I was like, and I remember talking to my father-in-law, who's a South Indian man, right, who worked for ExxonMobil all his life. He's like, what do you do? And I'm like, well, I'm an entrepreneur. And I think he must have said, this guy is either either going to make it or he's going to be a complete flunky. But my daughter is excited to marry this dude because for him, he didn't really understand what an entrepreneur was. Like, what is this concept of an entrepreneur? Is it another word for unemployed? And it perhaps was for him, right? And so I remember him asking me a lot of questions about but I think ultimately he came back to, okay, he has an engineering degree, he went to Stanford, must be something going for him. Don't understand this entrepreneur bit, but fine, we can get married. So we got married, and I remember we get all these check gifts. I had to use all that money to meet payroll. She had her first WTF moment. I have a deal kind of in the works. It's not sure what's going to happen, but I need to pay these guys in the meantime. Gonna spend this money. So she was quite happy, I think in hindsight, she tells me she was kind of happy to fund that. But yeah, and then the PayPal deal happened, and then I was at PayPal.
So how long did you spend at PayPal?
I was there for the requisite 4 years of golden handcuffs. So I spent 2 years in the Bay Area. I worked as
building that product. By when? Did you build and then did you commercialize? What all did you?
Yeah. So I remember a lot of the technology that we had built with a few consultants, right? We didn't have anyone full time. So I basically took all those consultants and the technology and we sold it to PayPal, right? So we went to PayPal and we spent the first year and a half rebuilding their entire mobile payment risk engine, right? So we used our technology, plugged it into their core. Of course, their scale was much bigger than ours, but the genesis, the technology was that. That's when I also started working on graph-related problems, right? So I basically said, hey, when you're detecting fraud, it's less important to know everything about Akshay. It's more important to know who Akshay is connected to and what is the plausibility of money transfer between Akshay and Anup or Akshay and Sabita and whatnot, right? So I started working on these connected nodes. The world cannot be looked at discrete individuals, the world is connected, right? So I started working on the graph stuff then.
The thesis here is that if you are doing fraud, then chances are that people in your network will also be involved. Like that was why you were looking at.
So it's quite simple, right? So PayPal is the business of sending and receiving money, right? Often the problem is you're sending money to someone you don't know, right? Or because you're not actually sending the money, someone else is remote operating your account, right? So someone takes over Akshay's account and sends money to Yuko, and Akshay doesn't know anything about Yuko or who Yuko is and whatnot, right? The money moved. Now, if you really knew Akshay's network and the network's network, then you could actually detect if there is a plausible chance of Akshay sending money to Yuko. And if there was, then you would not block that transaction, right? But if there wasn't, then you should block that transaction. And the other thing is, we would look at a transaction between, say, someone in San Francisco and someone in Austin. And that looks fairly normal, fairly obvious, within the US. But what you would actually see, and this is where my proxy piercing technology would play in, is well, actually, the actual machine that is accessing this computer in Austin and mimicking like it's coming from Austin is actually in Vietnam, right? And that the people connected upstream and downstream of that account of Vietnam, there have been other compromises, right? So this money movement is in a large mesh of money movement that is not kosher, right? So when you start to zoom out, that transaction between San Francisco and Austin starts to look nuts. You can't keep zooming out. If you zoom out too far, then you have so much data and you can't process the transaction. So there's all these algorithms about how far do you zoom out and how deep do you go and how do you do it in real time so you can actually approve the transaction. And that's all science and that's all IP and that's all cool stuff. Again, goes back to my bioinformatics days, because in bioinformatics, this is how you would not be able to process all the data, but you need to process enough data to get the right level of kind of depth and breadth to analyze your sample. So again, it's very different space, very similar thinking. So the graph and connected clustering algorithms are very similar to what I studied and practiced in my bioinformatics days.
Yeah, amazing how the dots connected, huh?
Connects backwards, right? It never connects forward. Backward. And I'll tell you more. This dot keeps connecting over and over again. It's kind of the pattern in my life. So in that piece of work actually brought down when I joined PayPal, I think they were running at about 6% loss rates on mobile transactions, brought it down to like 22 bits. So 0.22. So just by using this without any more degradation of, performance or quality, we were able to cut the losses, which was great. Then I worked on credit at PayPal. They were like, hey, you seem to be able to get shit done here really quickly. Why don't you work on, like, we want to do credit. So my boss had built a company called Bill Me Later and sold it to PayPal. So I started working on the integration of Bill Me Later and PayPal.
It was like a BNPL product.
Exactly. Back in, these guys sold it for like $1.5 billion in 2009, right? So, and here we are in 2022, still figuring it out. And yeah, so I worked on that, and it was a great experience. Again, had nothing to do what I thought I was going to be able to use it for, but again, 4 years later, it became a big deal.
So when you were doing that BNPL product within PayPal, it was essentially like figuring out the credit risk underwriting part of it, like how to do that.
So I think Bill Me Later had already figured out most of that stuff, but just how do you make it work inside a PayPal wallet, right? Like that was it. That was just like a glorified integration specialist, right? But when you're doing the integration, the curious mind, you end up learning a lot about it, right? And again, I think this goes back to just a poor education system that I was a part of. Because when you have a poor education system, you end up being more curious because you have to figure it out for yourself. Like you weren't taught properly and there's like 80 people in your classroom or something. And so you just become a curious mind. And so I just became very curious. And there were a lot of people to just learn from. No one was a teacher, but there's a lot of people to learn from. So I just kind of learned all the isms of credit through them. And man, like for me, I think I remember this quite clearly. My first week in PayPal, I had a skip level, right? Like basically my manager's manager, right? Basically sat me down and he's like, hey, okay, so 2 years from now, what do you see yourself doing in risk? And I was like, Gary, with all due respect, in 2 years from now, I actually don't see myself in risk. I see myself in product, and I don't even see myself in the US. I see myself in Southeast Asia. I want to run an emerging market. In magic, dude, just magic, and how the power of the subconscious works. 2 years later, I was on an expanded assignment in product in Singapore. So as part of PayPal. So for me, it was like, well, I knew I had to be there for 4 years at least to have my earn out. And I also wanted to just get an expat assignment under my belt. So I wanted to be a part of that experience. So yeah, that just happened.
But why did you not want to stay on in the US? You eventually came back to India. So like, why? And was your wife supportive of this?
Yeah. So my wife, actually, she was born and brought up in the US. She's Indian, but she was born and brought up in the US. Very familiar with the American way of life, very unfamiliar, other than the periodic summers that all American KC kids come and spend in India. Other than that, she had no experience of India, right? So I just thought in 2009, 2010, that the big waves of the US had come and gone. And that these waves would then kind of like come in the following 2 years, 3 years, 5 years in India and in other emerging markets, right? And that's what we're seeing now, right? To be honest, like India is super hot and has been for the last 3-4 years. So in some ways, kind of called it, right? And you can't jump in when the wave's already rising. You want to kind of catch the wave as it's rising. So jumping in at 2015 was like the most precisely timed decision, if you may. So as I was finishing up my 4 years at PayPal, that was 2015, we had two choices. One was head back to the US or head further east, if you may. We at the time were going through some personal stuff, which we were kind of like a shock in the family, which was holding us back from like heading back to the US, right? We had planned for a certain outcome. It didn't work out. So then we were like, okay, fine. If that's not where we're going, then I was just talking to my wife and I said, hey, I have this opportunity. We're already here. We've already experienced Asia Light. So let's go Asia Deep. And to be honest, the way I had sold it to her, and this is again like how one thinks and how one experiences life. I said, look, in PayPal in Southeast in Singapore, we're sitting on some $9 billion of profits. I don't think they're going to take it back to the US and pay taxes and repatriate and all this stuff. So my sense is they're going to have to spend it here in the region, and there's no good company to buy for PayPal. So and they really want to enter India. They really want to make a big splash in India. So why don't we go build something in India, A year or two later, PayPal's going to come. They're going to buy it. And I was like, man, it makes so much sense. They have the money. Yeah, they have the money. They have the appetite for the market. I can build something. I know all the people who I'd be dealing with on the other side. Could just be a quick 2-year stint and then we can do whatever we want. She was like, okay, makes sense. Let's do it. Of course, PayPal never came to India in a meaningful way. Kept getting distracted in the US and the European frontiers. Meanwhile, I kept building, we raised capital, and it became plan B, right? PayPal didn't come, but PayU was here in India. And for me, we started building a good relationship with them and brought them on the capital.
Okay, but before you come to that PayU, first, I want to understand, like, when you quit PayPal, what was your thesis that this is what I'll build in India?
My thesis was payments in India was broken, right? Like even for like a 20 rupee transaction, you had to put in your card and then you get an OTP. And if you were traveling, you would never get that OTP. It was painful. And so I was like, well, we have to be able to decouple purchase from payment, right? And then you decouple purchase from payment, you get some magic. And what I was also seeing is that the e-tail growth in India in 2014-15 was just going up, right? This is like the time of Flipkart and Amazon was coming in and like Aadhaar and this, that. Everyone was like buzzing about India. And I was like, man, e-tail growth is a precursor to payments growth, right? And I wanted to be part of the payments growth. So I saw the e-tail growth and I was like, this is the time to get into payments. And in the US, it played out very differently because the e-tail guys never wanted to really do payments, right? They were willing to partner and kind of invest and whatnot. But in India, it was different because the e-tail guys, whether it was a Book My Show or a Fasos or an Amazon or a Flipkart, they were all like, hey, we have our own fintech team. Oh, you want to buy now, pay later? They're also doing buy now, pay later. Oh, you want to do this? Oh, we can do this. So it was very hard, like, because I felt like half the time I was just educating them on how to do what I wanted to do, right? And so it was just a bit of that trick and that balance. But the thesis was very simple. Like, e-tail is booming. Payments will boom, e-payments will boom. Decouple purchase from payment because that's when you unlock massive consumer traction and a lot more trust comes into the system. But more
the consumer experience basically goes up a lot if they don't have to worry about putting in an OTP and all of that in the middle of.
Exactly, and then the more selfish thesis was PayPal will come. It's imminent, and that when they come, we can just package to sell. I was thinking I was only thinking about being in India 2015, 2016, to be completely frank.
Like, tell me about that, like from that idea, how you actually got it off the ground. Because I mean, fintech is a regulated space. You didn't have much idea about how to do it in India. This was a B2B business, or was it B2C? You would essentially tie up with the Book My Show and such and offer it to their consumers, right? So, I mean, there were a lot of buy-ins you had to secure to really launch this. So how did you go about doing that?
Yeah, so this part of the journey is a tricky one, right? So first of all, I initially thought I would set up in Singapore. In fact, the company is headquartered in Singapore. I was already there. I was going to set up in Singapore. The move to India was like was not even on the picture, or not even in the consideration set. It was just the market to enter. Right. And I was very clear about what I wanted to do. I wanted to build an experience where a consumer didn't have to do much, right? They were pre-approved based on some signals, and they would just kind of flow through a transaction, and then they would come back and pay up whenever they needed to, right? That was the basic. And I built a nice little kind of clickable prototype, and I showed it around, and I talked to people in the ecosystem. And I had a fair sense of like what I was getting into, but I didn't have really that much of a sense of like what this was going to be about. I also knew that this was going to be a big deal. Like if someone did it right, it was going to be a big deal. And so first I went and pitched it to a few VCs, right? And through my SayNow days, I had met the late Mr. Naren Gupta, who was the founder of Nexus. And his counsel to me was, hey, look, India is a great place, phenomenal opportunities, but it requires the entrepreneur to be on the ground. You can't do this from Singapore. Why don't you go talk to my team in India? So I was like, right, I'm going to plan a trip to India. This was in the US. I'm going to plan a trip to India. So I went to India. I met with Sequoia, I met with Matrix, I met with Nexus, and I met with a couple other funds. I forget the names now. And basically, again and again, I kept showing them this prototype, and I said, this is what I'm going to build. Guys, this is what's going to happen. Like this, you see this transaction on Book My Show, this is how it's going to be. And they were like, look, it's really amazing, like what you're thinking, but it's really hard. Is this even possible? Like, are you going to be able to pull this off? And I'm like, yeah, second time entrepreneur. I've done something like this in PayPal, but they were all like, dude, well, you're brown and you're Indian. You're quite fit on, right? Like, you're not from here. You'll not be able to cut it. Like, to be honest, like that was the biggest risk, right? They would ask me about like my wife and like how she was thinking about India. And like, because I think for all of them, the biggest concern was, at that time there was this wave of like, kind of like high profile folks that had moved from the US to India and then spun out. Right? Like they just could not hack it and they left and they went back. And so for them, the biggest concern was, well, we can't have this happen, right? Not after we make an investment. So that I got through that. And Nexus was like, look, if you're willing to commit to move to India, then we can write you a check. So very quickly with just that prototype, no company formed at the stage, they were willing to write a check. So then I went back to Singapore, formed the company. Still, my thinking was I need like someone who could help me operate in India. And that's where like just through social connect, I met this extremely wonderful lady called, never knew her, but met her. And she'd been in the US, moved back, had started a company, had not worked out. And so she was in between gigs that she was looking at. And so for me, I was like, okay, can we partner up? And the guy had very little India context. You're deep India context. My sense was, I would, again, build for a couple of years with her in India, and then I would go back to Singapore, and then she would keep working, right? And then I was thinking, we can go replicate this model in Vietnam and Indonesia and other markets, and that's what I would. But the struggle when we got started was so real, right? So on one end, we were building this technology in which we knew how to do. We were looking to do pilots with Book My Show and Fasos and I think Domino's and a few others, because all we wanted to do was just don't buy now, pay later. Had not quite figured out the economics of how this business would work. Now that I sit like in a very different credit position, I would like, first thing I'd say is that business is unviable, right? Like there's no point in business. But at that time, it was just like, just wanted to get the Book My Show deal going. And so from June till December, all I did was try to crack Book My Show. Spent all my time working with the founder, working with other people. And we just get strung along. And like you were saying, B2B to C is a very, very, very painful, very, very, very risky playbook, right? There is a company called Simple. They have cracked it. More power to Nitya and his team, but I was not able to do it. So come December, I remember having a glass of whiskey in my hand and Siley and a couple others in the room. And we were like, dudes, we have nothing to show, right? We have a pseudo partnership that's kind of working. They've given us some data. This data doesn't make any sense because it wasn't captured in the right way. And we were just like...
If you like to hear stories of founders, then we have tons of great stories from entrepreneurs who have built billion-dollar businesses. Just search for the Founder Thesis podcast on any audio streaming app like Spotify, Gaana, Apple Podcasts, and subscribe to the show.
As in, you couldn't underwrite using that data.
Yeah, the data was just like a bunch of cookies, right? It wasn't actually identifying a person. It was just identifying a cookie. And then people keep blowing up cookies. And if you could come from browser 1, browser 2, and mobile 3, I'd have 3 different cookies on the same person. And so it was very like fragmented, very poorly collected data. So we could not make much sense. And they didn't have a concept of a user. They didn't care because for them, all they were doing is selling a movie ticket. They didn't care about like a user and a profile and a wallet and money or any other stuff, right? All that stuff was coming. And so this was our like come to Jesus moment, right? Like holy shit, how are we going to make it? And just that Siley, more power to her, suggested that we go talk to Nirmal Jain at IIFL. And IIFL wanted to do retail personal loans and wanted to do it in a digital way, but just didn't have the DNA to do it. Now, for me, that's not what I wanted to do, right? But I knew that to demonstrate economics in 6 to 9 months from where I was, I would need to make that change at that point, right? And if I even waited or dilly-dallied for another month, that opportunity, that window would be gone because our runway would end and we would not have any traction. So middle of December, we said we'll build an app. It'll be for personal loans. We'll go and we will kind of generate loans or leads for IIFL, right? And that's how we pivoted. We pivoted And suddenly, like,
This is like a pure consumer business, like
pure consumer, direct to consumer. And you're probably wondering how we thought we would go and acquire customers. Yes, we did a little bit of Facebook, but man, I had gone and stood in tech parks, right? Where people come out for lunch and I was like, phone pay loan, phone pay loan, phone pay loan, phone pay loan. Just like people are selling. And like, this, after like telling you about my life for the last whatever hour and a half, this is the moment, the absolute pits of my life. There's a guy standing next to me with a Vodafone 4G SIM card, right? He's selling 4G SIM cards. And I'm standing next to him trying to sell a bloody loan pay phone, right? Or phone pay loan. And there's a line of people standing next to, on at his counter. And nobody wants to stop me. And here in the tech park, hounding people going in and out of their lunch breaks, trying to get them to take a loan. And this is what falling from stars feels like. But jokes apart, I did that for a week. Of course, the team did that as well with me, and we slowly got our mojo. We slowly try to figure out like, hey, what works and what doesn't work. And there is a big credit need in the market. It's just the right pitch, the right value prop, the right way. And we slowly got going. I remember when we celebrated doing like, I think 100 loans in a month. Right now, I think I do like 350,000 loans a month. It's like, and 100, man, it was so hard to do the first 100. We would have all these manual processes and what was coming from the app and storing in the database was off. And so I manually go and edit it to fix it. There was a bunch of paper processes where we had to like pair up this like NACH, the NACH form. We bought a paper cutter, and we'd have someone sitting there cutting the paper. It was brutally manual. Fast forward 3 months from that moment, at least we were funded, right? I had pulled the company from the jaws of failure because 2016 was brutal in India. 2015 was awesome. 2016 was like, show me the unit economics.
Yeah, absolutely. That's when like Snapdeal like had all those fumbles and
Snapdeal, Housing.com, Tiny Owl. There's a whole bunch of companies that went out of business. For me, it was survival, right? And when it comes to survival, I think this is where entrepreneurs really differentiate themselves. You have to make certain calls that you would normally otherwise never make. You would say, this is important. This is critical. This is something I cannot live without. And you basically, everything is obviously important, but there are things that you cannot live without. So you just kind of hyper-focus, and you basically put your ego aside, everything aside, and you just focus on survival, and then you make it through. And this is also when you go through this period where you're like, trying to say, man, did I start the right company? Did I start with the right people? Does this have legs, right? And while you're having all those massive self-doubt, you're going out there and telling someone to bet on you and bet on the company and believe the numbers. And so it's definitely a very tricky time. I still remember in Series A, I had pitched some 23, 24 investors and had been rejected by all of them because they were just like, oh, it's just not quite there. The economics is just not there. We're not feeling like this is the growth we want to see, et cetera, et cetera. And in the middle of this, I remember, without taking names, my CRO at the time, my chief risk officer, someone who was on the founding team, was based in Singapore. I flew overnight on an Air India flight from Bombay to Singapore, of course, economy, and pretty much couldn't sleep because it was brutal jet lag flight. Got to Singapore, and as I walk into the office, my CRO says, I just don't think I can continue to be at this. And I had come to Singapore to raise money, right? From one of my last ditch effort type of investors. And this is what I heard. I was like, holy moly, like a bat to the head when I walked in, right? So I grabbed a cup of coffee and it was a very emotional conversation. And basically the person had just made up their mind and it was just very disgruntled about like how we had not made enough progress, right? But for me, we had made a ton of progress. It's just the lens or the vision was very different. And we had to survive this period to get...
Which is also a factor of proximity to action, no? Like you were You had that
Media.
proximity to action.
Exactly. So if you sit far away, it just looks like nothing's moving. And you wonder, like, why can't you guys just go and get this deal signed? Right? We could, but it just doesn't work that way. So anyway, so this person quit, and I had like 10 minutes to just catch my breath, drink my coffee, get in a cab, and head to the next invest. In the cab ride, the whole time there, I was debating, should I just catch a quick nap because I hadn't slept all night? Or should I plan about how I'm going to tell them that they should support this company that was not doing that great and had lost its chief risk officer, like the single most critical role in a credit company, right? So I couldn't come up with anything. Couldn't take a nap either. Get there. And the first thing I open with is like, hey, look, this is where we are. This is what we've done. By the way, lost my chief risk officer this morning, but don't worry. I know enough credit risk. I'll handle it until we find the next person. And this is how I'm thinking about it. Very refreshing conversation, because I felt like if I had not been that jet lagged, I wouldn't have been that honest, because I would have been a lot more creative and they would have seen all the bullshit through. I was just so tired and I was so like F it types. I just gave them the real, and he was like very appreciative. He was like, hey, look, give us a couple of weeks. We understand it's early stage. We missed it when you were first raising your seed, but we want to get in. So we closed that round. And that was Jungle Ventures. Massive testament to Amit and kind of really backing the founder, even at a time where it was like complete distress. So I think it comes down to something very simple, right? Like, and I say this in hindsight, this is not about betting the horse. This is about betting the jockey, because the horse will go through its periods of life, success and failures and ups and downs, but the jockeys ultimately carry it. So I think, and there were many who did not bet the horse or bet the wrong jockey. Those are good venture capitalist friends of mine, but I still laugh in their face, right? I tell them that they bet the wrong jockey. So this business is brutal. And you started off saying, hey, it's a regulated space. It's India. Came into India not understanding it. People, it's tough. And yeah, but I think some people, just patting myself on the back, some people just make it through.
How much did you raise then from Jungle?
The Jungle round was a $5 million round.
Okay. So I wanted to understand a few questions on what you had built by the time you raised from Jungle. Like what segment were you going after? Was it for like salaried folks who wanted a loan, or was it for people doing business, or what? Like what was the segment you were targeting?
Yeah, look, I think it's even at that point we were still quite guardrailed by what IFL wanted, right? Like, so they were the ultimate lender. They were very clear about, hey, we want this type of profile, these type of customers, this credit score, and this is what we want to price for, right? So we didn't have that much control in terms of like who we were lending to. It was mostly dictated by the IFL credit team. But yeah, so mostly it was salaried, a little bit of self-employed, but not a lot of business lending, right? It was very like individuals for individual purposes. It could be a wedding. It could be like, it could be something, it could be health related. It could be like a home renovation. It could be like a festival and people wanting to spend on the festival. So just to smoothen out people's cash flow. That's typically was the use case. And the raise from Jungle was just about $5 million. And I think what we said is we would do most of the round and we would leave a little bit open. And the reason I wanted to leave a little bit open is because by this time I understood that to build a credit company or a credit-based company, you needed lots of capital for long periods of time, right? You needed like deep-pocketed, deeply committed ecosystem players who could keep shoveling cash in the form of raw material to generate a massive yield on the back of it, right? So, and by this time I was also very clear that PayPal wasn't coming. And I knew, and I think this is the difference between what other friends of mine didn't do and what I did, is I was very early gunning for a strategic, and my fellow competition or my competitors were choosing the next venture capitalists. And I was like, venture capitalists eventually are not going to keep pouring more and more money because this is a pretty poor free cash flow business. It has great revenue, great margins, but very bad from free cash flow standpoint. So you need to get in bed with the strategic. And at that time, there was only one strategic. There was only PayU. And so I wanted to leave $1 million open in that round with a chance that I can convert PayU. PayU initially said it was too small, too little, But once I raised from Jungle, for some reason the stars aligned and they were happy to put in $1 million. And
Yeah, okay, amazing. So what was the revenue model at that time when Jungle invested? Like, how were you earning? Was it like the spread? Like, say IIFL takes 16% and you take 8% and consumer pays 24%, like that kind of a deal? Or was it a per loan, like a lead generation deal? Or
so I think I forget the exact makeup, but I think it was one part for the origination and one part we earned through the loan as well. So because we were also responsible for helping them collect, they wanted us to have skin in the game in terms of making sure those loans were actually performant and that we could actually get consumers to pay back. So I forget the exact nature, but yeah, it was like one part like a commission upfront for originating the loan and one part like earned through the performance of the
like you had to do that, like what is called as a FLDG, first loss default, first guarantee, something like that.
Yeah, first loss default guarantees. Yeah, so I think in the early days it was something to that effect. Yeah, like I think it was like it wasn't called an FLDG, but it was like understood that we would protect certain percentage of the book, and we would only earn. Yeah, the reason it wasn't an FLDG is because look, we were not deeply capitalized, right? So if you're saying, hey, whatever, PaySense would put up 5% of FLDG, then you can only have 20x what you're able to commit as the book, and that was. That would reduce the appetite for the lender to grow. So then I think I think this was again to Nirmal's benefit. He didn't want to kind of like stifle us, and he wanted us to learn and grow. And so that's, I think, how it went.
Got it. Okay. And this did not really need like any kind of licenses because you were not lending from your book, so you didn't really need licenses.
Yeah. We were just an originator at that point, and then we passed it forward into IIFL. They were the lender. They did the underwriting. We were just kind of operating within their guardrails. It was their underwriting at play.
So how did it evolve from then? Like once the Jungle money came in, PayU's 1 million came in then?
So then the next part was just, I think we had also started to figure out, okay, how to originate. We had figured out how to kind of use social plus referrals plus other channels very effectively to originate more. We had also figured out how to generate certain signals which we could pass to the lender to help them underwrite better. And by this time, our graph had also been built up. Remember the graph I was telling you about for fraud detection? We had also built out a graph where people were connected and we could see that this is where birds of a feather do flock together, right? Like a good network is got a strong signal, positive signal. Networks with strong delinquents means there's like a cluster of fraud happening, etc. So we were able to kind of pass those signals. And then we brought on like a second lender, right? So I think we brought on Fullerton as the second lender. And then we were able to, and then we were also kind of starting to see that once a consumer borrowed from us and had done all the paperwork and done all the processing, we could also serve them better by A, lowering the rates over time, and B, making it more frictionless, our processes. But we didn't want to become like hyper sterile, right? Like we didn't want to be viewed as IIFL's digital growth strategy. We wanted to kind of make sure that we didn't want them to feel like that we were captive to them. And we didn't want to leave a perception in the market either that they were the only ones that we could serve. So we then diversified to Fullerton, opened up more geographies. At this time, it was still very Bombay, and we kind of started to open up in other parts of India. And the one thing we were quite keen on is ultimately to go acquire our own NBFC or apply for our own NBFC. So we started the work around getting our own NBFC as well. And the idea was we would raise capital for our NBFC and then originate onto self, right? Because A, you get to keep better. We had a percentage of the margins, and B, also the high interest rates that we were getting charged by the NBFCs was getting passed on to customers. And I was a bit against that because that just meant that we were always seeking into the riskier segments and the segments that really were desperate, right? So I actually wanted to get off of that. And the only way to get off of that was to kind of like have your own NBFC or your own capital. So I started to push in the other direction. That's a long process. Eventually, I think it didn't quite fructify for various reasons. We had eyes on a certain NBFC, but the RBI was not happy with them selling. It didn't quite work out. But then we kind of continued on the journey the same way. We basically added more lending partners in the background. We were able to negotiate better terms with those lending partners. But yeah, we just kept building this personal loan story and slowly ratcheted it up. And meanwhile, while the personal loan story was the front, the real asset that was getting built was the graph, right? By the time it was 2019, we had some 650 million nodes connected few billion times. And that was far more predictive and capable of, discerning good from bad than any bureau, any alternate data, and anything else. And we were able to demonstrate that. We could do like a simple, like A versus B kind of champion challenger with a bureau or with anyone who claimed that they had phenomenal alternate data. And we would horse race and we would always win. And that was the reason I think we were able to kind of survive where other lending startups didn't quite make it.
Okay. How did you build the graph? Because how did you get that data about the relationships between customers? Because you're not like a social site, right? So how would you?
So when a customer would borrow from us, one of the requisites was that they would download our PaySense app. And when they would have the PaySense app, one of the permissions we would ask them for is our contacts. And we would say, hey, use these contacts to kind of build a network score. And so when we didn't know much else about, so if I have your contacts, I would just know that these are people in your network. I wouldn't know much else. But then it just so happens that if you borrow from us, then you would tell a friend of yours, and then they would borrow and they would drop their app. And then at least like 5 other friends of yours will come and do a check. They'll check their credit score, check their limit, check their balance. And then you would get these dense clusters, right? So what would initially start off with a very sparse, unfilled graph very quickly had a fair bit of data that was contributed by the ecosystem.
And therefore, like clusters where there was more default would get a low credit rating, and clusters where repayment history was good would get a high credit rating. And so you were able to make better credit decisions right. Got it. Okay.
Yeah. And not as simplistic, but yeah, like if you basically, if you were part of a cluster where there were a lot of defaults that we've seen in the past, then you would have to really prove above the normal average Joe that you're amazing, right? You could still be a white swan amongst black or black swan amongst white, but you would have to really differentiate yourself from the cluster. Otherwise, statistics-wise, you're going to demonstrate the same behaviors as the cluster.
And by 2019, what kind of numbers were you doing, like dispersal?
We were doing close to like 100 and something crores, 110 crores maybe per month.
Okay. So 2020 is when, I guess, PayU did a acquisition, right?
That's right. That's right.
So tell me about that journey.
It was a long journey, and what started off like back in June of 2019 ultimately was consummated into a transaction in Jan 2020. PayU had been looking at other assets as well. I mean, they did have an investment in Zest Money, and they were looking at acquiring Cap Float at the time, and we were in the mix, right? And I remember this clearly, and you just feel like it's like I'm sharing this because it's the most odd things that come up eventually that you're not expecting. So I walked into one of the very famous investment bankers in Mumbai, and they were representing the seller to PayU at the time. And I knew this, but they didn't share this, but I knew this. And then the banker said, hey, this deal is going to happen. And it's really unfortunate because you guys are going to be collateral damage as a part of this deal, because once it happens, your strategic just bought like a very large company and you're going to be left on the sideline. And I remember that I was like, that really punched me in the gut, because it was like, and I think what he said is absolutely bang on. He's like, if these guys are looking out to purchase someone else, then you as a CEO have not done a good job in explaining why you fit into their world. It's not their job to figure out if you fit, how you fit. It's your job as a CEO to demonstrate that you do fit and how you fit, right? And I was like, man, this is such good advice. Like, I wish I had heard this like a few months earlier. And this deal was going to happen anyway, right? Like this deal was like 99% in, from what I understand from the public press, whatever. It was going to happen. And so all I did was I put together a simple 4 slides, and I was on vacation, and I called up the CEO of PayU and I said, hey, I want to walk you just through what we've been up to and how we fit in your world. And by the way, I'm going to do a fundraise, right? So, and because you're on my cap table and I'm doing a fundraise, and you have certain provisions, you're going to have to. So I did this pitch. I kind of gave them a very clear sense of like where we stood, how we add value, how we make sense, even if they, and at this time I was assuming that they were going to do that deal. So that it was going to go through. And I said, even in a world where you've done that deal, we still fit in your world, right? This is think of it as the $300,000 sale that I wanted to do with Quova. This is what this was. And I was like, we still fit in your world, and you shouldn't discard us. We're a good asset for you. And fast forward, for whatever reason, the other deal did not happen, but I had just raised capital from PayU. So they had just done full diligence on me. So they knew everything about me, my asset, and whatever else. I had just given them this big story. So it was very top of mind for them, for the executives at PayU, that, oh, this is what PaySense is and this is how they fit. And so when that deal didn't happen, I think it was a very obvious second choice. And so then that's how it, and then 6 months later, we were with the deal.
And this was like a pretty massive valuation, like $185 million valuation, right?
Yeah, so it was a 185. Yeah, and that's what like most of the investors exited at. I continued to stay on and kind of build. So I think I keep my stake in the entity, and that entity is worth a lot more now, which is great. But that's also, really, I owe it to the PayU guys to have that foresight to let the entrepreneur continue to build on the platform in a meaningful way. And as part of that deal, we brought in Lazy Pay, the NBFC, and PayU Credit or PaySense under one umbrella called PayU.
And then PayU already had this NBFC, Lazy Pay, or they acquired it?
They had one from a year prior, but I wanted all the credit assets to come under one umbrella. So that's how we...
And this happened, what, pre-pandemic or like once pandemic hit?
No, it's just before. I think we closed our deal in Jan, and the pandemic was March. So yeah, by the skin of our teeth.
So in 2019, you were doing about 110 crores of disbursement a month. You probably had a limited customer segment because you had only 2 lending partners. There was no lending happening through your own balance sheet. So tell me what's like a snapshot of things today, like from there, like what all are the types of customers that you're lending to? What all products do you offer? Is it still only personal loan? Just help me understand the business.
Yes. So today we stand at about 560 crores per month. And that includes buy now, pay later, as well as like personal loans. But what we've also started doing is creating a platform or an API approach where we're helping other fintechs and neobanks lend to their consumers, but using our engine in the background, right? They don't have to build all the intelligence, the tech, the loan management software to bring the capital. They can just participate in the lending. So in some ways, there could be 1,000 PaySenses that we could support today through our platform, right? Again, this comes from my early Microsoft days, right? So I always think of platform first. So you start off with an application, but then eventually you become a platform. You let others build on top of you. So that's what we're doing now. And I wouldn't be surprised if we're north of like 1,000, 2,000 crores of lending per month in the next 6 months, because the business is just going. And from a customer segment standpoint, it's very diversified now, right? I think we have customers who are well-banked, tier 1 CTE customers who are just looking to us as a convenient outcome because it fits more their type of borrowing, mostly in the BNPL segment. And we also have customers who are like personal loans borrowers, right? And then the good news is we've kind of systematically pushed our rates down, right? So we're down all the way down to like 13% for some segments of the customers, going all the way to like 22% for the others. But that was one of the areas that I wanted to kind of see our NBFC push the pressure down. And so we've been able to accomplish that.
So, and how many lending partners do you have now, like in terms of who are supplying the funds, and how much comes from your own NBFC now? Like what does that look like?
So we do about 50% on book on our own. And of course, we also match our own equity with debt from a large set of banks in the background. That's one half of the book. The other half of the book is we do have, I think, like 4 or 5 NBFCs and a couple of banks that we co-lend with. So we can originate, we might take 10% and then we might co-lend the other remaining 90% with a bank or with an NBFC. So there's a pretty wide, I guess, supply side now. And depending on what type of loan, what region, what customer profile, there's a lot of intelligence in the system to just automatically channel it, whether it goes to on book or it goes off book. There's a pricing engine that also knows how to optimize for the right experience and the right price for the customer.
Okay. And like you're still largely like a D2C play, or like so you said that you're now looking at fintechs as a source of loan origination. So how much is like your D2C play versus that loans through other fintech partners?
We're still, I think, 70, 80% D2C. The true fintech partners is still small because we're also looking to understand, right? We don't want to expose ourselves to risk that we may not otherwise carry on our own book through like easily counterparty risk, etc. So we're just being careful on how we grow that.
What is like the key lever for growth that you need to crack? Is it supply of money, or is it like building demand, like originating more more borrowers? Like, is it borrowers that you, or is it lenders? What do you need to?
Yeah, it's actually neither. It's actually the match that's off, right? So today we get somewhere close to 600,000 loan applications a month, right? We do about 300 or so, 350,000, right? And a lot of that is being built. So if I just look at personal loans, in personal loans, we'll see about 3.3 lakhs. So 330,000 applications for credit. And we may actually serve maybe 50,000, right? So there's the vast majority of the ones that we don't serve are not because they're not good credit or they're not servable. It's just that they just happen to be looking for a certain product construct that we don't have, right? They might be looking for like a 20-day loan where we don't do 20-day loan. Or they may be looking for like a bullet loan where they say, hey, 6 months I won't pay you anything. And then at the end of 6 months, I'll pay you a big fee and I'll pay you the full back. We don't do that. And that's more the case for like business type of loans. So we don't do those, right? So we do EMIs, and that doesn't fit for business. And the third could just be like geographies, right? So we only serve customers where we can collect. And so if you're 100% digital only, then we want to have some sense of comfort in terms of where you are. So that's the other part. Like, so we don't serve all geographies, all corners of India. I think the demand is there. The supply is also there. A lot of the supply goes unutilized. A lot of demand goes unserved because we're not able to match at 100% rate.
So probably like expanding the product portfolio, so to say, is like what will be like a lever for growth?
Product portfolio, underwriting mix, collections presence. I think there's a whole sequence of things that we need to do to just serve more.
So you built your in-house collections capability.
That's right.
Why not just outsource it to agencies? Like
a few different reasons. I think one is collections is a great way to get a pulse on like how to change your originations mix. And if you don't have anyone in-house driving collections, then you don't get a feedback loop that can change your originations and your underwriting mix. That's one. The second is collections is also, I think, is a necessary component of lending, but at the same time, it often goes wrong, right? Where customers escalate and customers say, hey, I got abused, or this this didn't go right, or this happened, or that happened. And those are all missteps. Those are not in our code of conduct or guidelines or whatever. So if someone is 100% on agency, then you can't hold anyone accountable and you can't take action, right? So this is the reason we actually like to keep collections in-house to the extent possible. But again, given the size of the loan book, it's not possible for us to hire thousands of people on roll. So we do a hyper where we have all the collection managers on book, and they spend time in agencies who ultimately are the ones who are the conduit. So any escalations can get resolved locally with the collections manager who are empowered to solve.
So how do you generate 600,000 inquiries a month? Like, what are your customer acquisition channels? What does the funnel look like? Like, what?
Yeah. So a lot of it is through partners. To be honest, I think there are a lot of people in a very distributed fashion. You can call them DSAs, or you can call them online aggregators. They are the primary drivers of acquisition. The second is we've also over the last few years built a very large buy now pay later base, right? So we have about 3 million customers who use our Lazy Pay buy now pay later app. And so to be honest, we are live with Flexo, but I didn't crack it. I think Lazy Pay had cracked it, and I just acquired Lazy Pay. That's another way to kind of go into that movie. So yeah, I laugh about this just as much because what I came here to start 5 years ago, I ended up acquiring 5 years later. So basically, we just ended up buying Lazy Pay from PayU and making it PayU credit. So they are live with like Swiggy and Book My Show and whatever. And that business, and I know that for a fact now, that business, like what I thought back then was like unviable, is unviable by itself. But you have to combine it with the rest of what we do. And I think then becomes like a great way to acquire customers and then cross-sell those customers on the personal ones. And that is, to be honest, a very large percentage of how we source customers into our personal loan as well. And the third is through our API.
Like the pure BNPL where like you pay at the end of the month, that is like a loss leader. But then some of those customers, instead of paying at the end of the month, would want to pay over a 3-month installment or something. That's where you make some money on that.
That's one part. And then some of those customers also will ultimately, because they do this month in, month out, they'll borrow some money. They'll say, hey, I have a expense. I want to buy a used vehicle or something. I want to borrow 60,000 rupees. They'll borrow it. They'll put that on EMI. And then you make some money.
So my last question to you, I know you must be quite tired by now. So I do interview a lot of fintech founders, and I've spoken to 3 other founders so far who are all building a platform play where they are saying that the way you can plug into, let's say, Stripe or Razorpay for a payment gateway, you can plug into us for offering credit. So how do you see that space evolving? Like I spoke to the founder of YouGrow, which is like a NBFC own book listed entity. And then there are 2 startups. There's one company called Hyperface. There's one company called Dero. So they're all building these rails through which you can just integrate and start offering credit. So how do you see this market evolving?
Yeah. So look, I think there's two ways. There are 3 players in credit, right? There are people who distribute credit. This is the Creds of the world who basically acquire customers with like brand campaigns, credit card payment, whatever. ATM, and basically what they do is they kind of cross-sell them credit, right? Credit does it with IDFC and a few others, and there's this, that's how that works. That's interesting. I don't think that works in India at scale because I think you can earn 2%. Yes, it's risk-free, but the cost of acquiring that customer and the cross-selling them, it just doesn't quite work out. You have to amortize that customer across so many different products that doesn't quite work out. The second is, like you mentioned, Hyperface, and we have Wibmo and a few others. These are like pipes, conduits, rails, intelligence, middle layers, right? So again, middleware in India has never done well. Middleware around the world has done well. Middleware in India has never done well because middleware in India just gets the price compression constantly, right? No one wants to pay for stuff.
Give me an example of what you mean by middleware. What would be another?
Middleware is basically
like something which is done well outside India, but not in India, like as a concept.
Yeah. Let's take Plaid, right? Like a Plaid, however you want to say it. They are basically a way to connect between in other markets, right? So basically, and they were valued at like whatever $4.5 billion, and I think they got bought. But they truly are like pipes between banks, right? They're middleware, right?
Or like Visa, MasterCard would also be like.
In Visa, MasterCard,
they have like a consumer facing.
Yeah, exactly. Middlewares are not well branded, to be honest. Like Visa, MasterCard are well branded. So middleware is not typically well branded. It's like
NPCI in India is like
that's to be a middleware, right? So it's important, but it's not like consumers don't like identify with it, right? So those are middleware software companies, and they basically so someone said, hey, I can I can do OCR scanning for you. I can basically convert printed documents into digital formats that you can do. That would be a middleware company. And year after year, when I write a check to them, I'll be like, hey, can't you do this for a little bit cheaper? Can't you do this for a little bit cheaper? And I will never let you build a very big company on the back of like me paying for it, right? So that's typically what happens in middleware companies. So I'll always ask for volume discount or a brand discount or some discount to basically say, eventually I'm only going to pay you 300,000, but the value will be for more and more work that you do, right? So that's a second. And the third is people who manufacture credit, right? Like whether that be a Bajaj, PayU credit, like any like reasonably sized bank or NBFC, there you do make money. And the reason you make money is because you also take a lot more risk. You also have a lot more capital. You have the regulation. You kind of figured out so many different things that need to go in sync for you to be able to manufacture a credit product for a consumer, right? And then that product can be distributed by anyone you want, and then you can pay them their CAC, and then they can move off, and then you can monetize the customer over time. So I feel like people who are investing in deep, differentiated manufactured products will survive. People who manufacture commoditized products will not survive because they'll just get like price compressed. So for us as a strategy, we always think about new to credit. We always think about thin file, not because you can price them more inelastically, but because no one else is competing for them. And that's where like when you don't build all this graph technology and all this underwriting and you have like 40 people in data science to basically look at the bureau and give a personal loan, right? Like that's just such a huge waste. We do all this because we want to serve the people who are not on the bureau or have a very thin trail on the bureau. And so I believe that we need to continue to manufacture products that no one else can. And when we do that, that's a subtle difference. So lending has three pieces, right? So you need to be able to acquire at scale at low cost. So that's where our BNPL, Swiggy, BookMyShow kind of partnerships play a huge role for us. You need to be able to manufacture or underwrite customers in a differentiated way with data that's uniquely yours. That's where our graph and some of our other kind of repayments information or BNPL repayments information is uniquely ours. And the third is you need to have access to very low cost and very deep amounts of capital, because ultimately capital is your raw material. And that's where process plays a huge role for us, or PayU plays a huge role. And that's what I realized like 4 years ago. Venture capitalists will eventually not be able to win this game, right? Venture capitalists eventually, I mean, today, yes, there's tons of dry powder. So they're like just throwing it around as if capital is free. But eventually, they're not going to continue to plow billions of dollars into a company as raw material. So that's I think, how I see like this kind of playing out.
Okay. So you, as an entity, essentially still like fundraising from PayU, right? Like, and what is the valuation you are at, if you are at liberty to share? I'm pretty sure you said no, but no harm in asking.
Yeah, definitely no harm in asking. And yeah, definitely. It's much higher than where we started off at 185, that's for sure.
If you like the Founder Thesis podcast, then do check out our other shows on subjects like marketing, technology, career advice, books, and drama. Visit thepodium.in, that is thepodium.in, for a complete list of all our shows.